Well, thank you guys for joining us. Excited to talk today with one of my favorite life insurance experts and our resident IUL expert, Jason Herring. Jason, welcome.
Hey, good morning, Steve.
All right, so it's a pretty cool topic today. We're going to be talking about sort of the overall umbrella of retirement planning, right, Jason, with IULs, and specifically, you guys, if you're just tuning in, if you've heard of the LIRP, that's life insurance retirement planning. Is one term that's used to refer to this kind of planning. We also sometimes call it a tax-free retirement planning, having a tax-free component to your overall retirement plan. Could be a Roth alternative. So, and I'm pretty excited, Jason. I know you're going to show us some examples, some illustrations as to how this can work for someone in their retirement plan.
Yeah, I mean, we're just coming out of a year with 2022 when the S&P was down 19%. So it's a lot of people are seeing the advantage of IULs right now when they're looking at their cash value and realizing that they didn't lose any cash value last year.
Right. So wrapping a contract around that account, taking advantage of the index with a floor of 0 or whatever.
So the great thing that we do here is we really go through and educate you on what you can and what you can't do with these products, so that you have all the information you need to be able to make an informed decision. And as you can see from this example here, we're going to solve for what's the least amount of death benefit we have to purchase, in order for this strategy to be maximized for cash value growth. Okay. So in this example here, we got a 35-year-old male who is a preferred non-tobacco risk, and they can do $1,000 a month. We have a planned monthly premium of $1,000 for 20 years. So a total premium of $240,000 over the 20-year period. Now, of course, that's flexible. We can, you can pay it longer, you can pay it shorter, but this is just what we have designed here. So what I did was I took his $1,000 premium and I solved for the least amount of death benefit that he has to purchase, which is $238,000. The death benefit is going to increase for the first 20 years. So if he were to pass away during those 20 years, he's going to get the death benefit plus his cash value. Then typically we level that off and change it to a level death benefit, because it does cost more money to receive both your death benefit and the cash value. So as you're getting closer to retirement age, we're looking for ways to even cut the cost inside these contracts to minimize the cost, so that we're designing and building more cash value. So, so I really like the way Lincoln does this one page. This is one of the carriers that we use. We're an independent organization. We have access to 15 good indexed products. This is just one that I think illustrates well in one of our, I would say probably in our top 3 of who we like.
Yeah, and Jason, we granted, if you're watching this webinar, a year from now, that may have shifted. So we always get a little apprehensive with products, but this is the one that we're working with quite often.
I like Lincoln because this page really is a great visual of not only are you getting a death benefit, but you're also getting some living benefits as well. There's also a terminal illness rider on this policy. There's a chronic illness rider, and there's a critical illness rider. So even though the policy is mainly designed for death benefit and cash value growth, if life happens and things happen along your journey with this policy, you can access the death benefit to take care of some chronic illness needs and some critical illness needs. Critical illness is a little bit different, built around, having some type of stroke, cancer, heart attack,
Right. People don't understand that, critical illness being an event, like where there's medical intervention. Chronic is a long-term, like, where someone needs nursing care, skilled, really for life. You mentioned keeping the death benefit down. People get confused about that. You keep the death benefit down to get more cash into the policy, and that lowers the cost because you're not paying for as much death benefit. However, there still is a death benefit. So you also mentioned if somebody dies, they get the cash plus the death benefit. That's kind of unique to IULs, I think.
Definitely. So as long as you have that death benefit option chosen that is the increasing by cash value, you get the base death benefit of $238,000 plus whatever cash value is in the policy. So what we're trying to do here is, like I said, we're taking this amount and we're just simply overfunding the policy. We're figuring out what's the least amount of death benefit we have to buy. And a lot of times, Steve, what we will do too is we'll show people, hey, 238 is the least amount, but you have to remember too, that's going to lock you into not being able to put any more than $1,000 a month into the policy, right? So a lot of times what I'll show them, look, if you want to completely, just bottom line maximize your contract, this is the least amount of death benefits you have to purchase, right? So what we might do is we might take this death benefit. We know that the minimum is 238. We might take that and bump the death benefit up to, let's say, 300. So what we would do in that instance is we would still keep your plan premium at $1,000 a month. Okay. But what it might do is, let's just say it's going to give us room to do $16,000 a year. So what that would do is that's going to give the client the option that sometime during that year, if $4,000 more becomes available, they can simply pour that into the contract and overfund it. So let's look at the indexed accounts, because probably one of the biggest questions I get is, how do these policies grow money? Okay, how does your cash value grow inside of a policy? Well, at the end of the day, this is a fixed product. Okay, so the best way to think about this is a fixed product. All of your cash value stays inside at the insurance company, and the insurance company is simply going to credit your cash value every year based off of how well an index performs. About every company out there has the kind of tried and true index, which is the S&P 500. Okay, that's obviously made up of the top 500 companies in the U.S. It's got the most historical data available to it. A lot of companies do a 65-year look back to kind of gauge on what type of maximum illustrated rates they can show. But in this example with Lincoln, you can see that they're going to give you 100% participation rate with their S&P 500. Okay, so simply what that means is, if the S&P does 9%, they're going to give you 100% of that 9%. And they're currently offering a 9.5% cap, so it's a pretty strong cap in the industry. What that means is, in 2023, you have a policy, the S&P returns 20%, they're going to credit you 9.5%. The good news with this, Steve, is that if the S&P 500 were to return a negative return for 2023 like it did for 2022, 19%, negative 19% was the return in 2022, the insurance company is going to credit your money zero. Okay, credit your cash value zero.
So you're not dealing with digging out of a hole as if you, in the same way that if you had an index fund of some kind.
Exactly. So an index strategy, you have to live with the realization that your growth is going to be capped, but you don't have to ride the negative years that can be so detrimental to your cash value, especially as you get closer to retirement.
So if they go negative 19, you've lost 19% of your basis, so to speak, right? It's going to take longer. Let's say the market goes up 19% the next year. You're not going to get it all back.
Yeah, for sure. So yes, it takes more than just, having a positive 19% the next year, that you're not breaking even. It takes a little bit more than that to get to your break even point. So any option we show you is going to have this S&P 500. Most of the caps right now are ranging from 8 to 10%. You can't just go after the highest cap out there, because there's so many more factors that I take into account when I'm trying to figure out what's the best company I'm going to put you with, because company might be offering a 12% cap, but their charges are just so astronomical that when you have your 0% years, there's a lot of money that could be coming out of your cash value to pay for fees and costs. Most of our clients come in, they're happy with the S&P 500, Steve, and we just put them there. We do have some clients that are coming in and they're more aggressive, and they want to go after larger returns than a cap. one of the reasons I like Lincoln right here is that they do have an uncapped account. So this Fidelity AIM dividend account, and it also has a fixed bonus built into it. And it's one of the few products on the market that has a bonus built in that doesn't also come with an astronomical cost. Okay. So the way this works is you can see there's no cap here, right? So if the S&P does a positive this year of let's just say 20%, they're actually giving you 140% of 20%, right? So it's a very large participation rate that they're currently offering. Now, as you can see right below it, you know, at any time they can lower their participation rate all the way down to 25%. So if that were to ever happen, you know, you would probably want to shift more of your money over to the S&P 500. But also like the fact that they're paying a current 1% fixed bonus. So if you would have been in this bucket, in this index account for 2022, and we had that negative 19% return, you would have at least been credited 1% on your cash value. So if the S&P returns 10%, you're in this bucket, you get the 10%, plus you get the additional bonus of 1. And you're always going to have at least a 0.25% guaranteed minimum bonus. So if you're in the Fidelity account here, you're always going to have at least a floor of it being 0. It's going to be at least 25 basis points there.
The annual reviews are part of this. You know, people sometimes don't realize that, you know, you got that relationship.
Absolutely. So every company has to show their absolute worst case scenario, Steve. So when you're looking at these columns, typically what you're going to see is the far left side is the worst case scenario. You're looking at, in this instance here, you can tell I'm using the Fidelity account because we have a 0.25% floor here. So a guaranteed interest rate at 0.25. But what this is also showing is that Lincoln is charging the maximum policy charges allowed by the state of Tennessee in this example. Okay. Something that very, very, very rarely ever happens. I don't know of a company that has ever charged their maximum policy charges, but every company has to show it.
So they can't illustrate, you know, some, you know, returns and then go ahead and charge more in costs down the road.
This is illustrated off of the max charges allowed. So if you ever wanted to see what would happen to your cash value or policy if you only got a 0.25% rate of return for every year. Okay, I'm talking about every year inside the policy, 0.25%, and a guaranteed interest and a guaranteed maximum charges. So, you know, we're not allowed to say this is never going to happen, and we don't say that because in that scenario, you would see the policy would actually lapse when this client is 67 years old. So,
but, you know, the thing that blows me away about these illustrations, just on a personal note, is that when people are looking at other kinds of products financially, they're always illustrated with sort of these averages, right? In a very advantageous manner, where insurance companies tend to have to paint a worst case picture.
So I would say usually the most two columns, we always explain the far left column. The far right column is what we're really working off of here, because this is the current charges that the insurance company is charging. And I went in and just said, what if this 35-year-old over the life of the policy simply gets a 6% average rate of return? And you can see the 20 years of premium going into the policy. You can see the death benefit increasing here. So the death benefit is increasing by the policy value. So if you take 238, 339 and add 9373, you can see that at the end of year one, death benefit has grown. So you can see the death benefit growing. You can see your policy values are growing here. And then you can see the surrender value. So the biggest problem that I see with the people on TikTok today is they're not explaining what bucket of money is available for loans early within the policy. So you put 12,000 in, you can see we're overfunding this in a very nice way because we're putting 12,000 in. And by the end of year one, we actually have $9,300 of cash value. If we were to design this policy going after maximum death benefits instead of max cash value, you would literally have probably zero cash value in these policies for several years because all of your premium dollars are going to cost. So you can see by year 10, based on 6% rate of return, you've put in 120 and you've got 132. Let's say in year 3, you're showing $29,000 of cash value here. but you want to go out and take them, and you're thinking you wanted to take a $25,000 loan. Well, the money that's available for loans with an IUL is you can only loan from your surrender value. So you actually only have a percentage of that $23,000 available.
Mm-hmm.
So IULs work great when clients don't need to take loans from the policies in the very, very early years.
Mm-hmm.
And when I say very early, Steve, I'm talking like years 1 through 5. Okay.
Mm-hmm.
Because I'm going to design the policy, and it's going to be optimized to the point to where you're going to be able to get to some pretty good money by year 5.
Mm-hmm.
But I just want people to realize that your cash value is not what you have available to loan from in the first 10 years of the policy. It's your surrender value.
Yep.
So we've paid our premium for 20 years, and then we stopped paying. And what we've done is we've just kind of allowed the cake to just continue to bake, right? I mean, that's what we're doing here. So no more premiums going into the policy. Death benefit, it still continues to increase. And then what we did is we said, look, what can we do with this policy? If I want to wake up one day when I'm 66 years old and I want to just call the insurance company and say, how much money can I take out per year from ages 66 down through age 85? Okay, so 20 years of distributions.
Mm-hmm.
And I want to make sure that the policy doesn't lapse. So I want to make sure that there's enough cash value in the policy to carry it, until I'm 100, 110, 115. Okay.
Mm-hmm. So
this strategy looks really nice. So you're looking here at $84,597 of tax-free retirement income.
Okay. So tax-free is huge. So this is the retirement planning component, 84,597 tax-free. In the taxable world, if you were looking at a retirement account, you'd have to pull out maybe at least 100, probably.
At least 100, probably. We're looking at 31 years from now. So if we can only imagine what Congress is going to do to tax rates over the next 31 years, none of us think they're going to go down, right? Yeah. So if you're taking this same $1,000 a month and you're putting into a taxable strategy, like a 401k or an IRA, and you get to age 66, we don't know what the interest rate is going to be. And when I say interest rate, I mean what Uncle Sam is going to charge us for taxes. If we use this non-qualified, which is what life insurance is, a non-qualified account, we remove the fear of taxation, and we remove the fear of what's going to happen with our retirement funds later on in life. Certainly good, get that free money from your company, but maybe instead of if they're matching 3%, instead of putting 12% in, get your 3%, but don't put an additional 9% into a taxable bucket that you have no idea what the interest charge is going to be on it one day. Well, and it goes back to the old analogy, is that if you ask any farmer, would they rather pay taxes on the seed or the crop, they're going to tell you the seed every time. You are going to be able to harvest all this crop one day, income tax free, through a tax code that the IRS has right there in the tax book called 7702. And it's all built around the favorable tax laws of taking loans from the cash value of a life insurance policy. It's nothing new. It's been around forever. The whole idea of a Roth IRA came from, cash value life insurance. So it's
interesting point.
You're just also having to spend some of that premium dollars to pay for costs, because that's the vehicle that the government has given us to do this. Yeah. So at the end of 20 years, so the client is 85, we have a total net outlay here of $1.4 million. So what that means is we put in $240,000. We took our $240,000 back. So every dollar we put into it, we got back for tax-free retirement income. Plus we took an additional $1.4 million of tax-free income. And if this client were to pass away at age 85, they would still be leaving a net $278,000 death benefit, tax-free death benefit to their family.
Can you explain the net death benefit? What does the net mean after the withdrawals, after the surrender value there?
So what the net death benefit is, it's taking into account everything that's going on in the policy. So when you take a loan from a life insurance policy, there's really only two ways to get rid of that loan, Steve. You can either pay it back or you can pass away. Okay. So life insurance is a self-completing contract. So when you pass away, any loan, any outstanding loan that's on the policy is going to come off of the gross death benefit, and your family is going to receive the net death benefit.
If you were to pay it back, you'd have an increased death benefit from what this is showing. However, this is a non-paid back loan because you're making withdrawals via policy loans and you're getting that tax-free income as a result. Correct?
That's correct. So this design here, with the LIRP strategy, life insurance and retirement planning, is what LIRP stands for. That strategy is built around taking loans as tax-free retirement income and having no desire or no plan to ever pay that loan back. And that loan is just going to simply come off of the gross death benefit, leaving your family a net death benefit whenever you pass away. Okay.
Yeah. Yeah. So in this example, you could have continued to draw down if the person's over 85. I noticed you just kind of cut it off as far as life expectancy.
One of the reasons I did, and I was a little bit conservative with this, because you can see as the client gets older, at age 105, the death benefit starts going up, the cash value goes up. Typically, what I will do is I will solve for $1 of cash value left in the policy, like at age 110, and what that would have done is it would have made these distributions even larger. Okay. I tend to err a little bit on the conservative side, because the one thing you never want to have happen is a policy to lapse.
Right.
If the policy lapses and you have a gain in the contract that you've loaned out, you could possibly have to pay loans on all those gains that you took out of the contract. Sometimes I'll be in competition, Steve, and I'll show somebody 84,000, and I'll see another advisor and another agent is showing the same scenario with loans of, let's say, 96,000 per year, and they're like, Jason, he's beating you. Well, I'll say, well, send me the design and let me look at it. So they send this illustration over, Steve, and I look and I see that there's $1 left to cash value at age 86 and the policy's lapsing, and they don't understand to look for things like that. And that's a very, very aggressive design that could really be detrimental to the client if that policy were to lapse and they're still alive. Okay.
So you got some padding here is what you're saying.
Yeah. So we built in some padding, and, and keep in mind, this is only based off of a 6% rate of return. If you look at the 25-year historical, the S&P were well over probably 6.5%. So once again, I'm being conservative from a standpoint and showing up a 35-year-old only getting a 6% rate of return over the life of the policy.
With a floor of 0.
With a floor of 0. And if you're using this one account, if you're using the Fidelity account with this company, with Lincoln, you actually have that 25 basis points with your floor, which is nice. So I think probably to just wrap this up a little bit, one of the most important things is for your agent that you're working with to be very transparent with you. And that's one of the things that we do. And it's amazing how many times I see competing illustrations come over to me, and it's a 50, 60-page illustration, Steve, and there's no cost report inside the illustration. And a lot of times you see that with certain agents that are doing it with certain products, because the product illustrates so well. They have these large non-guaranteed bonuses built in, and the cash values are just through the roof. But they just very conveniently forget to add this report. Okay. And when I'm trying to figure out which products we're going to use for our client, I'm looking at 3 main things. I want an A+ rated company that's been around forever and going to outlive both, me and you, the client. Okay. I'm looking for companies that have good history with their caps and some nice variety with their index buckets where we can choose different things if we wish. But then I'm also looking for cost, because one of the biggest detriments to growing cash value is the cost inside these contracts. So when people are wondering what types of costs are in these policies, you basically have a premium load, which is sales tax that you're paying back to your state when you're purchasing a product. Your policy charges right here, you'll see them called expense charges sometimes as well. This is everything that the insurance company needs to keep the lights on and to have a 500-person call center and kind of house all those people and service your policy for the next, 35, 40 years as well. Okay. And then you actually have your cost of insurance. So one of the
heavily weighted costs in the first 7 years, it looks like.
It is, because most of the companies are going to get their loads in the first couple of years. Because if you pay one premium payment and pass away, they have to pay that $238,000 death benefit out, right?
Yeah.
So policy charges are usually front loaded. And then you can see with this example with Lincoln, they really drop at year 8. And then by the time you get to year 11, you dropped all the way down to a $72 policy fee every year. So when I'm looking at, this strategy and looking at which IULs we're going to use for our client, it just makes me so much more comfortable knowing that when we have these 0% years that you're going to have with an IUL, that our clients aren't having these very large charges come out of their cash value in years where you're not getting, any crediting to your cash value.
This particular illustration, you had premiums being paid for how many years?
For this one, I did 20 years. 20
years of premiums, and after that, not paying any premiums. And you have the withdrawals starting at, did you say 66?
Correct. And you don't have to wait till age 66. Sometimes maybe if we have a potential client that comes to us and they already have kind of built a very large, qualified asset like an IRA or 401k, and they're trying to delay having to use that money for as long as possible in retirement. Sometimes you can use this as a bridge. Maybe you want to retire at age 65 and you don't want to touch the IRA until you have to at age 72 and a half, when you have to start taking that required minimum distribution. Maybe you just use the IUL for, 5, 6, 7 years as your main source of income until you have to start taking money out of your IRA. When we're doing our annual reviews, we can look and see, we can run what's called in-force illustrations. So we can call the company and say, hey, give us a picture of what's happened to the policy so far, and then give us a picture of what's going to happen to the policy if this, and this happens. So, there's a lot of things that can go on, but this is just showing you when you're seeing this information online and you're seeing the TikToks and the YouTube videos, this is what you should be seeing from somebody that knows how to design these products, having that floor protection and not having to ride that roller coaster down the negative side. And still with products like what Lincoln has given us here to be able to go after uncapped returns, that's just a great use of your money. And I'm not talking about cashing out your 401k. I'm talking about just shifting dollars that you're already, putting into your 401k, maybe moving and reallocating those dollars on a monthly basis into this strategy. Again,
And for any of you just coming to us for the first time, if you're part of the INE tribe, we just really wanted to get into some details, give you an idea about the way that these policies are designed. Jason, I appreciate you jumping through the details here with folks. Any final comments as we're wrapping up?
No, I would just say that as you're hungry for more information, the website InsuranceandEstates.com has some, just some really great information built around IULs. And if you go back there, a couple of things, you can get in touch with me. You can send me an email at jason@InsuranceandEstates.com, and you can reach out, and I'll be happy to follow up with you and book some time to do a introductory call with you to kind of learn more about your goals. If you go back to the website, you can look in our articles around IULs, and you can see a link to my calendar, and you can simply go in there and book some time on my calendar as well.
Yep. In fact, wherever you're watching this webinar, there's probably a link below to Jason's calendar if you want to get started looking at this for yourself. Thanks so much for joining us, guys, and we'll see you in the next one.